We're going to calculate the stock price for Six Flags using prior financial information. And the first step is we need the market cap, which is 1.946 billion. And then the stock price 22.98. Now we know how many shares the company has outstanding. You take the market cap divided by the stock price and it has 85 million shares outstanding. Next is free cash flow. And the best way to forecast the future of a business is to figure out the future free cash flows of the company and discount those numbers back to today's value. And that's pretty much what we're doing in this DCF model video today. The next thing we need is net income, which is on the income statement, and that's the profit or loss in a given year. And last is revenue, which are the sales for Six Flags in the past 4 years. We're using 4 years to calculate the future value. You don't want to go back too far, but you want to have a good amount of data. And you should always look, even if you're inputting or copying into a model, you should always kind of look at the numbers to see how things move and change. And everything looks fairly consistent. There was a little drop off in 2019 in sales. Probably be a big drop off in 2020 with coronavirus. Now we need to look at the capital structure of Six Flags and figure out the discount rate we need to apply to the future cash flows. So the interest expense is the interest they pay on their debt, and it's 114 million. And let's see how much debt they have. We'll go to the balance sheet, then we'll go to the liabilities section, and the current liabilities is only 8 million. That's the debt due within 1 year. Non-current is debt due beyond 1 year, and that's 2.2 billion. So they pay 5% interest on the debt. Not the best rate, but it's okay. Now let's figure out their effective tax rate, because interest payments are tax deductible. So let's see the income before tax, 311 million. And the income tax, 91 million. So they pay 29% in taxes. So the cost of the debt is actually 3.56%. It's not 5%. But we need the cost of equity in order to figure out the discount rate. And we need the beta of this company. It's 2.21. That's pretty high. That indicates it's a volatile stock. Anything over 2. It moves more than twice as the market does. So you can see the cost of equity, we use the CAPM model for that, is 19%, and the cost of debt is only 3.5%. Now, equity is more expensive than debt because equity sits lower on the capital structure of a company. And in the event of a default, debt holders are paid first before equity holders. That's why equity tends to have a higher return, because there's higher risk. Now this number, 10.81%, is the price Six Flags pays to obtain financing, whether through debt or equity. So Six Flags needs to generate at least this much profit a year to add value to its investors. And if it does not, for year after year, it will eventually go bankrupt. But this is their discount rate. Every company has their own discount rate. So let's check to see our calculation. And we forecasted the future free cash flow for 4 years, and then we did a terminal value, which is all the years beyond 4 years, and we used the Gordon growth model for that. And then we discounted those numbers using the WACC, and the sum is 2.6 billion. So that's the value of the company according to this model. And if we divide that by 85 million shares outstanding, we get a calculated stock price of $30, and it's trading at $23. So we consider this a buy. And you can see it was trading even a lot higher, even 60 or 70. So it was trading at a premium for a while. Now it's trading at a discount according to this model. Now, some people may not feel the stock is worth $30 because it's pretty likely that the sales will go down, because I don't think people will be going to theme parks as much this year or next year. So stocks could obviously trade higher or lower than intrinsic value, but the stock price is predicated on supply and demand of the market. The more people that want to buy the stock, the higher it goes. So it was kind of purchased down the stock, bought down until it came to $23. So if you do research, you'll find some analysts will say Six Flags is a buy, while other analysts say Six Flags is a sell. But each analyst uses their own model and their own unique assumptions. But you never actually see their model. But this is my model, in my opinion. So I hope you liked the video, and thanks for watching.